Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing. We're going to deconstruct the fundamental, data-driven differences between venture capital and private equity. The private markets have quietly become the absolute cornerstone of the global economy. But look, the macro shifts of 2026, stubbornly high interest rates, inflated asset prices, and a massive liquidity bottleneck are forcing both asset classes to radically adapt. We're going to look strictly at the economic mechanics differentiating these two giants and exactly why the lines between them are increasingly blurring. Here's our roadmap for today's breakdown. We're starting with the baseline mechanics, moving into VC's AI power law, tackling PE's megadeal reality, exploring the extended holding dilemma, and finally looking at how to restore LP alignment. Let's dive right in. All right, Section 1, defining PE versus VC. We really need to understand the baseline mechanics here. To grasp the current 2026 market dynamics, we first have to establish the baseline operational differences between these two private market powerhouses. They operate at entirely different stages of a company's life cycle, representing a core divergence in capital deployment strategy. Venture capital is all about innovation-led disruption, right? VCs typically take minority stakes, backing a founding team's vision and aggressive scale, usually way before the company has even achieved profitability. Private equity, on the other hand, targets true enterprise-grade durability. PE firms generally acquire majority, controlling stakes in mature, revenue-generating businesses. They're looking to drive EBITDA optimization, essentially maximizing core operational profitability, along with serious margin expansion and cash flow predictability. Because venture relies on early-stage startups without those stable financials, it accepts an immense risk-return profile. It's wildly volatile. Around 80% of VC investments completely fail to return capital. Just think about that for a second. If you had those odds at a casino, you would literally never play. But for venture, this isn't a bug, it's the core feature of the entire model. PE firms, conversely, lean on their operational expertise and debt-fueled stability to ensure a fundamentally lower failure rate across their portfolios. Moving on to Section 2, VC's AI-driven power law. This is all about the intense concentration of outlier returns. So what is fundamentally changing this traditional risk-return profile right now in 2026? It's artificial intelligence. The whole venture model relies heavily on the power law to offset those brutal 80% losses we just talked about. VCs are making a calculated bet that a tiny fraction of massive unicorn-level winners will generate outsized returns that cover the rest of the portfolio and then some. Historically, one grand slam would balance out a whole lot of strikeouts. But AI isn't just changing the game. It is drastically steepening this curve into an extreme winner-take-most environment. Just listen to this data. Looking at venture exits since 2023, the top 1% of companies represent 80% of total venture capital exit value. AI is literally absorbing over 80% of U.S. venture dollars by early 2026. The gap between outlier companies and everyone else is widening at a speed we have simply never seen before. To really wrap your head around this concentration, you just have to look at the sheer scale of modern private companies. AI models like Anthropic are commanding astronomical valuations, reaching a staggering $965 billion while remaining entirely private. To put that into perspective, that single private company is roughly the GDP of the Netherlands. They're hitting $30 million in annualized revenue in a fraction of the time it took the previous software generation. It's completely unprecedented. And the ceiling just keeps rising. Look at SpaceX, recently hitting a valuation of $1.25 trillion. These figures completely dwarf prior cycles. What this proves is that the winners are capturing exponential upside, and they are staying private much longer than ever before. This is actually forcing VCs to adopt deep-pocketed, PE-like rigor just to keep funding these giants round after round. The key takeaway for you here, top-tier companies simply no longer need to go public to find deep pockets. Let's pivot to Section 3, PE's megadeal and liquidity reality, a very narrow recovery powered by giants. So meanwhile, private equity is facing its own unique reality, dealing with elevated interest rates and massive capital concentration. Following a pretty brutal macroeconomic period full of tariff shocks and inflation fears, global buyout deal value actually surged reassuringly by 44% to hit $904 billion. On the surface, that sounds amazing, right? It marks the second best year in history for the industry. However, that massive top-line recovery is deceivingly narrow. Just 13 mega deals, we're talking $10 billion or more, accounted for 69% of the entire growth in deal value. Think massive public-to-private transactions backed by sovereign wealth funds. Below that ultra-high mega deal thresholds, the overall deal count actually fell by 6%. It is an incredibly top-heavy market right now where assets remain stubbornly expensive.
That brings us to Section 4, the extended holding dilemma, or what we call the $3.8 trillion mountain.
This is the converging bottleneck for both asset classes, a massive shared liquidity crunch. With interest rates sitting high, debt becoming a lot more expensive, and corporate buyers getting super hesitant, general partners are being forced to hold on to their portfolio companies much longer. The timeline for holding aging assets has stretched from a historical average of 3 to 5 years all the way out to an average of 7 years today. And look, this extended timeline is highly toxic to fund performance. Time literally eats into returns. The data shows that the internal rate of return, or IRR, which is the annualized metric institutional investors care about most, begins to stagnate right around year 7 and actively declines after year 8. Why? Because holding assets longer to try and force growth eventually destroys the time value of money, completely eating away at the core value proposition for investors. As a result of this gridlock, the exit pipelines are massively backed up. The industry is sitting on a towering mountain of dry powder, which is unspent capital waiting to be deployed, and an absolutely unprecedented $3.8 trillion of unrealized value. That capital is locked up in roughly 32,000 unsold companies. So this brings us to what is easily the most critical question in the market right now. How do limited partners, the LPs actually providing this capital, navigate this bottleneck? Distributions as a percentage of net asset value, meaning the actual cash returned to investors compared to what their portfolio's worth on paper, are hitting multi-decade lows. We're talking hovering right around 14%. LPs are seriously struggling to make new commitments because their capital is just trapped in these aging funds.
Which leads us to our final act, Section 5, restoring GP and LP alignment in a truly high-stakes era. The resolution to this gridlock lies entirely in how fund managers respond to this intense LP pressure. They have to carefully balance the need to deliver immediate cash distributions against their core mandate for long-term return generation. To survive this hyper-competitive new era, secure future fundraising, and restore investor confidence, firms are being forced to strictly adhere to the ILPA principles. These guidelines emphasize absolute alignment of interest, incredibly strict fund governance, and deep reporting transparency. The days of easy money are officially over. Institutional rigor is now the absolute baseline expectation.
Now, we are seeing GPs utilize some new financial engineering tools to cope with this. Continuation vehicles, where a GP sells an asset to a new fund that they also manage just to generate cash for LPs, are growing at a rapid 62% year over year. But while they do provide some defensive liquidity, let's be real, they're only a partial fix. They still represent less than 10% of total PE exit value. Ultimately, investors don't just want financial reshuffling, they are demanding true fundamental operational durability and actual realized exits. This stark advice from the recent Bain report perfectly captures the clinical mindset required today. GPs must ruthlessly evaluate their portfolios. They have to ask the hard questions. Can they genuinely generate further EBITDA growth to justify holding an asset? Or frankly, if the juice isn't worth the squeeze, they need to sell it, take the return, and give the capital back to their LPs. Ultimately, this leaves us with a provocative thought to ponder. As exit timelines stretch and the power loss steepens, the gap between top-tier funds and the rest of the pack is becoming an absolute chasm. Do you have the data-driven rigor and the operational excellence required to adapt and unlock value in 2026? Or will you be left behind, holding aging assets in a rapidly shifting market? Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.